This is a simple example of what an IUL could look like for an entrepreneur whose main goal is maintaining liquidity for when opportunities arise, wants to invest in himself, but still, of course, wants to make some gains in the meantime. So let's take a look. One thing I want to mention before we get started, I did reference the IUL simulator in the CRM from Doug Andrews' IUL Insiders. I'll pop it up on the screen here. This is only hypothetical and does not represent any insurance company or actual IUL product. This is intended to be for educational use only. Please consult with a licensed professional to acquire an illustration from an insurance company. Let's get into it. In this example, I chose a 40-year-old male who's putting in $500,000 over the course of 5 years. Just hypothetical, could be older, younger, putting in more or less money. This is just what I chose for this example. Before we kind of dive deeper into these numbers and show you how accessing the money, putting it back, and all of that would work, I want to go over each of them. So of course, age, we have our premium, that's how much you're paying into the policy. Then we have our policy loan. So in this, for example, if you took out $80,000 this year, then that's our loan. And of course, that loan is accruing interest. So this would be our loan balance. So if our loan, in this example, it's saying our loan is 6% every year. It's always going to grow by that. That's just the example we went with. You can see here that that's our loan and that's our loan balance. So if you took out more money, the loan balance would continue to go up and continue to accrue interest. That's our policy loan and our loan balance. Next is our accumulation value. This is how much money we actually have working for us. So the reason that's different than the surrender value, the surrender is how much we have access to. So for example, if we took a $400,000 loan this year, we might still have the same accumulation value. So that's how much money is working for us. We have $538,000 there. But you can see our surrender value is much lower because we don't have access to all this money because we already pulled out $400,000. So the surrender value, that's what we have access to. Accumulation, that's what is actually working for us. And then if we remove the policy loan, lastly, we have the death benefit amount. Pretty self-explanatory. If we pass away, this is what would pass on to our heirs, of course, tax-free. What we're going to look at here is what the policy kind of looks like as we start taking different variations of loans, when we're accessing money, what happens if we access it right away in year 2, for example, right at the beginning, or wait all the way till year 5, taking different loans throughout. We're going to look at that. It's probably going to be a video a bit more for an engineer type. If you are someone who just kind of wants to see, hey, if I took these loans, what do the numbers look like at age 60, 70, 100? I have those columns highlighted, and we will also show those. So if you just want to see what's the final number, I'll show that, but we are certainly going to get into the details here. So let's go ahead and do that. All right, year 1, 2, 3, 4, and 5, we put in the 100,000. Let's say in year 2, we want to take an $80,000 policy loan for some sort of venture. We take out the $80,000, we go and use it in our business, on ourselves, in some sort of investment. We go ahead and do that. We still put the $100,000 in though that year. Third year, we put in the $100,000, we don't do anything. In the fourth year, you want to access $200,000. So we pull that out. Pull out the $200,000. You can see that the surrender value over here is $79,000. Our accumulation value is $413,000. That's how much money we have working for us. But since we've accessed this $280,000 and let that build up, we only have access to the $79,000. We continue again in year 5 with the last $100,000. Then let's say some of these loans that we took out and put into our business or put into ourselves really started to pay off. We got some money back. All right, so we can fund back the policy. So we put in, let's say $125,000, we put back in here in year 6. And we continued to do that for the next year. And then our loan balance here was the 93. So we pay that off entirely. Now what's great about this is if you never wanted to touch this money again at this point, when you fully paid it back, you've got this full accumulation and surrender value. You could let this grow forever. For example, if we just let it grow, we never took any more loans, it's going to continue to, and then we could of course access it when we want to. Problem is you're an entrepreneur and you probably aren't going to do that. You're probably going to pull money and start to use it again. So let's say here in year 9, well now you need $400,000. So you pull out the 400. Your loan balance is going to start to build. Of course, again, same thing. The accumulation value here is a 668, but since you have that loan balance, your surrender value here is much less than the accumulation. So on this piece, this surrender value, we're getting the full, or we're linked to an index, we're getting, let's say, 7% on average. At least that's what this illustration shows. Then with the 668,000, you're also getting that full interest. The difference is you also have a loan balance of $424,000 that's growing at 6% on average. So even though you're getting the full 7 on this 668, and you'll continue to do that, you're also getting 6 on this number. That's where you're creating that 1% spread on the money that you've already taken out and spent, and that's where you would really begin to kind of create that cash cow. Let's continue down. So you took out this 400. Over the next few years, you're slowly paying back 100,000 at a time. As that investment starts to work out, a few years later, you finally pay it back off entirely. And you don't have to pay this back. This is just if you did. Of course, you would have all the room to put that money back in. So you might want to do that just because, hey, it's going tax-free here. It's already fully funded, as opposed to throwing it in a mutual fund or a managed account. If this is what you wanted to do, you could do that. So you really funded it all the way back up. Your loan balance is now 0. That's great. Again, you have this full $915,000. That's all working for you. If you never wanted to touch it again and just let it grow, you could do that. But problem is we're an entrepreneur, so we're probably going to start taking money out again. So we're going to do one more iteration here. You have the 900,000. This time around, we want to take out 600,000. Same thing, we slowly start to pay that back. Let's say we're paying 150,000 at a time. We do that, and then we have this remaining 107, 371, 4, and we pay it all off. Again, you don't have to do that, but if you did, this is kind of what it looks like. So the main point here is you were very active in this policy over these, say, 20 years. You were taking out money, you were using it for your business, you were putting it back in, and we still had this original 500,000 grow to about the 1.46. And this is really where an entrepreneurial type or someone who is much more active in the policy is going to see those sorts of advantages. Yes, they always want access to their money, but they still want it to be working for them. So, you know, the business didn't go incredibly or anything of that sort. They still had somewhere where they were kind of setting something aside, whether it's for retirement or if they don't even need the money to pass to their kids, where it's growing, and it doesn't have to be optimal, right? There's technically, you can never hit optimal, but it's likely growing much faster than it would sitting in a bank or it's sitting in a mutual fund and you need to keep pulling it in and out. And once you're pulling it out, you don't really gain anything from the money that you have pulled out. So we won't run any more loans here. Of course, if you continue to take out loans, pay them back if you did or didn't want to. But what I'll do here, just for the people who wanted to see, hey, if I was really active like this and took out the 80, the 200, the 400, the 600, and was slowly paying it back, what would some numbers kind of look like? Again, completely hypothetical here, but in this hypothetical illustration, we can see here at age 60, this is the number that's working for us. This is the number we have access to. And if you were to pass away, that death benefit would pay out tax-free to your family, of course. So here's age 60. We have age 70 down here, even all the way to age 100. It could, of course, go farther. I just illustrated it out to here. You can see there's -3 cents because my software isn't perfect. But yeah, you can continue seeing it to grow and getting the tax-free benefits. That's pretty much it. This is a real simple, just kind of explanation of what a hypothetical illustration would look like. Just putting in the 500,000 as someone who's going to be really active in the policy. If it was helpful to see these numbers, or you'd like me to go into more detail or have a little bit more structure behind hey, what would it look like if I was pulling out here and putting back there, feel free to comment any sort of situation. I'm happy to make a video on that and run through it in a bit more detail. If you found any of this helpful, be sure to subscribe, and I will see you in one of my future videos. Bye-bye.